Hi folks, welcome to today's Bobcast from Bob Benny Wealth Management. I'm Bob Benny.
I'm Jessie Thompson.
And we're both certified financial planners here in Lincoln, Nebraska. And just today's topic on our Bobcast is how to invest for children or grandchildren. We're just going to go over a few different kinds of accounts and how they work, just kind of give you the basics.
Yeah, so there's several account types that you can use depending on the situation to invest for kids or grandkids. This is a question that we get asked quite often actually, because there's different rules on each one and people wonder what's the best for their type of situation. So we're just going to dive in and tell you about a little bit about each one.
Yeah, the three different kinds are one is called custodial accounts or uniform gift to minors acts.
Or uniform transfer to minors. There's two, UGMA or UTMA.
Yeah.
The way that they work is basically the same.
Yeah.
They're very similar.
And then, so there's custodial accounts, there's Section 529 college savings plan accounts, and then what's the third one?
A Roth IRA. You can actually invest in a Roth IRA for a child if the child has earned income.
Correct.
So maybe not a baby, but you know, if a kid starts doing chores or something like that around the house that you're paying them for, you can invest in a Roth IRA for them.
So first off, on the custodial accounts, Jessie, go ahead and explain how a UGTMA account works.
So UGMA or UTMA.
Yeah.
There's slight differences to them, but for today's purposes, we're just gonna act as if they're interchangeable. So a UTMA is an account that it's owned by an adult for the benefit of a child. When the child reaches the age of majority in our state of Nebraska, that's age 21, the account automatically it's restricted for the parent to do anything with the account, and it has to be transferred to the child. So the ownership has to be changed to the child for them to be able to do anything in the account. The parent or grandparent, whoever the adult is, and it can be any adult, can no longer have any rights on the account after the child is 21.
But up until age of majority, the child doesn't have any rights.
Right.
Correct.
And they own it, they run it. It can be invested in anything in the stock market, stocks, bonds, anything. It's basically a brokerage account for an underage person run by an adult.
And it's taxed differently than some other kinds of these accounts we're going to talk about.
Yeah, so the earnings in this type of an account, the first $1,350 of them, so think about dividends or capital gains, that is not taxed at all. Okay, the first $1,350 of that. The next $1,350 is taxed at the child's tax rate, which is probably going to be nothing or super low, right? Because most of them probably don't have any earned income. And then anything above $2,700 is then taxed at the parent's tax rate. To have $2,700 of earnings on a kid's account, the account's going to be probably semi-large in order to generate that amount of earnings by the time it gets there. Yeah.
But these details
so
of this I guess we just want to give you a little bit of information on each type of account and understand that your particular situation, if you have a child or a grandchild, we'll have to get with you and work on your particular situation to figure out which one is the best for your family. The next category is Section 529 college savings plans.
Yeah, and these plans are plans that grow. You put money into these plans, the money grows tax-free, and then when the kid is in college, as long as the money is used for eligible education expenses, when the kid is in college, any withdrawals are also tax-free. So it's kind of similar to like a Roth IRA for a kid, but all of the money is specifically earmarked for college expenses. If the money doesn't get used for eligible college expenses, then it's still taxable when they take it out. And I believe there's a 10% penalty, isn't there?
Yeah, and there's also, it not only includes college expenses, but housing too. So it's a pretty good deal. One of the neat things about these two, the college savings plans, is that you can change the beneficiaries on them if you want. So if you had a grandchild that didn't end up going to college and didn't need any money for college, you could change it to another grandchild. and it also includes, they can use it not just for college, but for trade schools and things like that. So Section 529 plans are appropriate for certain people in certain situations.
Yep, and if you are the owner of the 529 account for the benefit of a kid, you remain the owner of that account forever. So it's not like the other account that we talked about, the UTMA, where when the kid reaches age of majority, they automatically take it over.
Yeah.
They never take it over. Something that you can do if the kid doesn't go to college, besides transferring it to maybe another child or grandchild, is you can have the money converted into Roth IRA money up to, as long as the account has been open for a certain period of time and you've been contributing to it for a certain amount of time. You can convert it to Roth IRA for them, and the maximum that you can convert every year is the Roth IRA contribution limit. So you could convert, like this year, you could convert $7,000 to IRA for them and start them a little retirement milk cow.
So one of the neat things about the 529 is that, like she said, you have control over it, or their parent or whoever you name has control over the account. And it isn't like all of a sudden the kid reaches age 21 and can go and, if they're not responsible, like they could in a custodial account, it's their money. They got $20,000 in a custodial account and they turn age 21 and they're not mature enough to handle it. Tough tooties, it's their money. So
the last type of an account.
Tough tooties.
The last type of an account that we're going to briefly talk about here is a Roth IRA. And like we said, as long as the child has earned income, you can contribute to a Roth IRA for a child as a grandparent or a parent up to the amount of earned income that they have in a certain year. The limit for this year is $7,000. And so if the kid is doing
let's say the kid
paid for, works in the family business that they get paid for,
or they they're 15 or something, they have a job at McDonald's, a part-time job at McDonald's, and let's say they make $5,000 in a year, and maybe they use it or they spend it or they whatever. It doesn't have to be their $5,000 that goes into the Roth IRA. You can put that $5,000 from your account into their Roth IRA to get them rolling. So it's kind of neat that way.
Yeah, and anyway, just Roth IRA money will grow tax-free, and they have so much more time for their money to grow tax-free when they start this early. It's incredible. And then they could use a Roth IRA for a down payment on a house, because you can take a certain amount out of a Roth IRA for a down payment on a house tax-free before you're 59 and a half. So really great way to get them set up.
So those are the three different types of accounts that can be opened up for children: custodial accounts, college savings plans called Section 529 college savings plan. That's the number in the IRS code that it applies to. That's why they call it Section 529. And then Roth IRAs. But if that's something that you or a family member would like to talk to us about, you can either call us and talk to us about it or send us an email or whatever, so that we can help you understand it and get started if you want to.
All right. Thank you very much. Have a great day.
Thank you.